What is up, you guys? Pete DiCarlo here, and today we're going to be talking about GameStop. This is something that I've had friends, I've had families, I've had literally everybody under the sunset asking me about. And so in this video, we're going to go over GameStop, and we're going to go over more specifically what exactly happened, how it happened, and will something like this ever happen again? So sit back, hit the like button, subscribe to this channel. It really means a lot to me. And let's get started. So taking a look at the charts first, for anybody who has been living under a rock, GameStop has been on an absolute tear. If we just take a look at the 4-hour chart, you can see that back here on 1/11, which was 20 days ago now, the stock was trading at about $14 per share, and we just most recently hit highs of $513, which is a 3,451% return. I've had so many people asking, should I be buying this? Should I be selling this? And that's really what I want to go over, is how did something like this happen? Because if you're somebody who's not a trader, not an investor, you just heard about this at work or something, like, you shouldn't be touching this at all. The only people who should be touching this is people who truly understand what's happening and are willing to lose whatever they put into it. So let's start talking about what exactly happened. So for those of you who do not know what Wall Street Bets is, essentially it is a Reddit community. They've been around for a very, very long time. I used to be a pretty active member back in 2015 before it got like really memey and crazy. And what one of these Reddit founders, I think they were a moderator, actually found was that GameStop was heavily shorted. Now, for some of you who have been in the investing world for a while, you probably know that there's shorting and puts, and for some of you, shorting and puts might mean the same thing. It might be completely different, but we're going to go over the difference of the two of them within this video. But somebody realized this was heavily shorted, and it's not like 20%, 30%, 40%, 50% of the shares were shorted. 114% of the shares out on the market were shorted. And some of you might say, well, how is that even possible? How can there be more shares that are short than shares on the market? We're going to talk about that, and that's extremely key in this. That's why this happened. It's kind of like the golden unicorn setup that made this possible to happen. So what these people realize, well, let's first of all talk about the difference between shorts and puts. So a put is a contract in which you think a stock is going to go down by a certain date and a certain time. If you guys want, go on YouTube, just type in Peter DiCarlo, my name, and look up options. You'll see a whole bunch of options videos I've made from complete basics, beginners, teaching you about options and whatnot. Go and watch those if you don't understand this. But essentially, a put is a contract that you make with somebody saying that a stock will be a certain price by a certain date. So let's say you get a put on GameStop that expires tomorrow, and you think the GameStop's going to close tomorrow below $240. If it closes below, you make money. If it closes above, you lose everything. You lose all of your premium. So let's say you put $500 up. If it closes at $320 tomorrow, you lose $500. A lot of people mix shorting and puts up. They say like, oh, I'm shorting the market, or I'm shorting this stock. That's, if you got to put, you're not shorting it. You might be short, you might be against the market, but you're not shorting the market. Shorting works this way. You borrow shares against the stock. So let's say that GameStop is trading at $60 a share today, and you're going to go short one share. What you would do is, if you go short at $60, let's say the stock goes down to, $30. Well, guess what? You made money. You made the difference between what you borrowed the stock at, which was $60, and what the stock is trading at right now, which is $30. So you give the shares back that you borrowed at $60, and then you keep that $30 spread between 30 and 60. That's $30. So you would have made $30. Congratulations. Let's say it doesn't go your way. Let's say you went short at 60, and now the price of stock is 120. Well, you would lose the spread between the two of them. So you would lose $60 because you have to give back the shares, and you lose the spread between the two of them. So you lose $60 in this situation. Well, what Robinhood found was that there was 114% of the shares short. How is that possible? Because you're borrowing against it, which means you can actually borrow more shares than there even are out in the market. And so what Robinhood users said is, listen, Wall Street is huge short against GameStop. If we just put all of our money in GameStop, we pump GameStop up, we make a ton of money, and the short sellers lose a crap ton of money. Now, the reason this works so well is because when you are short on a position and you're getting your butt handed to you the way that Wall Street was getting their butts handed to them, you have to do what's called covering your short position. And what happens with this is, as the stock is going up and up and up and up, and you're losing and losing and losing, eventually you have to cover your position or buy the shares back that you borrowed and take that loss. But here's the key thing. If you are trying to buy shares now, it's $260, so you're trying to just get out, like you're trying to just cover your positions. How does the stock price move? So what you have to think to yourself, how does the stock price move? Somebody has to offer more than what you're willing to sell it for. So let's say that everyone's holding shares at 260 and Wall Street's trying to cover their shorts at 260, but nobody sells. Wall Street's going to have to try to cover at 270. Nobody sells. Wall Street has to cover at 300. Nobody sells. Wall Street has to cover at 340. Nobody sells. Wall Street has to cover at 400. Nobody sells. And so now, since no one's selling, but Wall Street has to cover, and there's just not enough shares to even cover, they're artificially pumping the stock up. And so what happens is eventually we hit like 460, 480, 500. People start selling to Wall Street. Wall Street starts getting squeezed out. It's called a short squeeze. And now the stock dumps. If it was just GameStop, it wouldn't have been a big deal. But what made it a big deal, and we'll talk about what happened, is they started doing it with BBBY. They started targeting all these short companies. BBBY, Nokia, TR, which is Tootsie Roll, EXPR, which is Express, NAKD. They started targeting all of these, AMC. They started targeting all of these heavily shorted companies and squeezing out everybody within it. And so yesterday, because of volatility, TD Ameritrade announced that they were not going to allow people to trade those stocks on their broker. Then Robinhood came out today and said that they're not going to allow you to buy any more of these stocks. And Wall Street put an end to it very quickly. And that's why we see GameStop is bouncing a little bit. That's why you see this massive sell-off of about 80% in just 1 hour and 46 minutes. Because if you can't buy and you can only sell, what's going to happen to the stock? It's going to go down. And the reason Wall Street did this, and I think it's disgusting, I really do, because at the end of the day, Wall Street has been manipulating the stock market for decades. And then finally, retail investors get a little bit, get one over them, and they shut it down. And the reason they shut it down, and the reason these brokers like Robinhood specifically and TD Ameritrade, which I love TD Ameritrade, but still it's messed up. The reason they're doing this is because they make more money off of Wall Street than they make off of us. How much money do you guys pay in commissions? For about 80% of you, nothing, zero. I pay only commissions on options and OTCs. And the amount that I pay every year in commissions is like fractional of what these people pay in commissions. Because if you're going short on companies, you're usually paying high interest rates to go short. And this, if they allow this to happen to people just to squeeze shorts out the way that they have been, there will be no more shorting stocks. Nobody would short stocks because once it got out to the public that a stock was shorted, the public would pump the stock up. It's absolutely insane. And so that's what's happening, guys. In my opinion, don't touch GameStop. Don't touch AMC. Don't touch any of these companies. Even if you were to invest in GameStop long-term or AMC, we are nowhere near the prices that you should be trading at. So please do not touch these. Please. Yes, you could probably make tons of money, but the chances of you making a ton of money at this point right now that everything is kind of over with, is extremely slim. Thank you guys for watching. Hit the like button, subscribe to this channel. It really means a lot to me. Thank you guys for all the support over the past year. Let me know if you guys have anything you want me to talk about. If you have any questions, comment down below. I'd love to help you guys. Have a good day, and I'll see you next time.